Life insurance is a defensive tool. It has one specific job: replacing your income if you aren't there to provide it. It's not an investment strategy. It's not a path to wealth or a lottery ticket for your heirs. You buy it to cover the heavy financial obligations that would crush your family without your paycheck: paying off the mortgage, keeping the lights on, and sending the kids to college. This creates what we call the vulnerability window. It happens when you are young. Your savings are low, but your debts and responsibilities are at their absolute highest. The true value of any life insurance policy is measured by how well it guarantees your family survives that specific window of time. When you sit down to buy a policy, the industry presents you with two very different paths: term life and permanent, or whole life. Term life expires. You pay for it over a set number of years, and if you don't die, it ends. Many people hate this. It feels like throwing money down the drain. Permanent insurance preys on that feeling. It promises a payout that lasts forever and includes a built-in savings account that grows cash value over time. The choice between them comes down to a mathematical trade-off. Do you need maximum financial leverage right now, or do you want a permanent asset? The problem with permanence is the immense, often unsustainable cost required to maintain it. If you don't unbundle the math behind these two options, you fall into a binary trap. You either overpay massively for coverage, or you leave your family dangerously underinsured. Let's look at term insurance first. You pay a very low, fixed monthly premium for a set period, usually 20 or 30 years. In return, you get massive financial leverage. A small monthly payment can instantly secure a $1 million death benefit during the exact years your family relies on you. The trade-off condition is simple. At the exact end of your term, the policy expires completely worthless. This sounds like a flaw, but it is actually the goal. By the end of the term, your target is to be entirely self-insured. Over a couple of decades, you pay down your mortgage. The kids move out. You contribute to retirement accounts and build real assets. Term insurance is a temporary financial bridge. You rent the coverage while you accumulate enough of your own wealth to make an external insurance company obsolete. Permanent insurance requires a much heavier lift. For the exact same death benefit, your monthly premium is typically 10 to 15 times higher than a term policy. Sales pitches justify this by promising a guaranteed lifelong payout, plus a tax-deferred cash value savings account attached to the policy. But there's a massive hidden trade-off. Your premiums don't all go to savings. A large portion is diverted immediately to pay for heavy administrative fees and agent commissions. Because of these costs, your cash value grows at an agonizingly slow rate for the first decade. The ultimate structural danger is the price tag itself. Because permanent insurance is so expensive, buyers are forced to purchase significantly less death benefit than their family actually needs to survive. By forcing a single product to do two opposing jobs, protection and savings, permanent insurance often fails at its primary objective. It leaves you underinsured. There is an alternative strategy that solves this problem. You separate the two functions of whole life into distinct, highly efficient actions. Step 1, you purchase a cheap term policy. This secures the massive death benefit leverage immediately. Step 2, you take the premium difference, the massive amount of cash that would have been spent on whole life every month, and you invest it directly. You put that money into standard, low-cost investment vehicles, like an S&P 500 index fund. This chart shows the mathematical outcome over a 30-year horizon. On the left, the slow, flat growth of a whole life cash value. On the right, historical market returns compounding your invested difference. There is a major behavioral caveat to this strategy. It requires extreme discipline to actually invest that difference every month, rather than spend it. The failure point happens when you buy term insurance, but use the leftover cash for lifestyle inflation. Unbundling provides mathematically superior liquidity and returns, but it shifts the responsibility of execution entirely onto your personal discipline. To decide which path to take, we have to look at your specific scenario. The ideal term insurance candidate includes young families, mortgage holders, and those actively in the wealth-building phase of their careers. This profile covers roughly 95%. You require maximum coverage for minimum cost. The permanent insurance candidate is different. High net worth individuals, typically those with assets exceeding $13 million. In those specific cases, Permanent insurance provides guaranteed liquid cash to pay complex estate taxes or to fund trusts for lifelong dependents with special needs. Protecting your family from disaster and building generational wealth are two entirely separate financial jobs. Insurance should always be viewed as an expense to minimize, not an investment to maximize. By unbundling the math and choosing the right tool for the right job, you protect your downside while building your upside on your own terms.